For over 6 decades, Indian tax jurisprudence operated on a single framework. Now, that entire legal infrastructure is being dismantled. This diagram reveals the precise scale of the reduction. The legacy 1961 Act carried over 800 individual sections, spread across 47 chapters. The 2025 Code compresses that mass down to just over 500 sections and 23 chapters. Over 64 years, the 1961 Code accumulated layers of patchwork amendments. The resulting compliance environment became bloated and highly prone to legal disputes. The 2025 Act strips away that accumulation. It rewrites the temporal rules of assessment, forces a total migration of compliance nomenclature, and alters the friction costs of market trading. For financial professionals, navigating this transition requires treating 2025 as a brand new systemic operating language. The legacy framework must be completely unlearned. The most significant structural flaw of the 1961 Act was its staggered, dual-year accounting model. This timeline illustrates the problem. Income generation and tax reporting were separated into a previous year and assessment year, perpetually offset by a full year. The 2025 Act eradicates this bifurcation, merging them into a singular tax year. This unified methodology officially activates for the financial cycle beginning April 1, 2026. Any financial filings processed prior to that date remain strictly locked within the legacy PY and AY matrix. By collapsing the temporal axis into a single metric, the Act removes a major vector for filing confusion. The audit lifecycle for both corporate and individual entities becomes significantly more linear. Moving into operational mechanics, the Act initiates a mandatory nomenclature migration across all standard compliance identifiers. This mapping table outlines the code changes for standard deductions. The monetary limits remain identical, but Section 80C now routes to Section 123, and Section 80D maps to Section 126. Payroll identifiers undergo a similar shift. Form 16 migrates to Form 130, and Form 16A becomes Form 131. The 26AS ledger shifts to 168, 12BB updates to 1244, and 15G/15H consolidate into 1221. The legislation also expands statutory filing deadlines, specifically targeting non-salaried entities. Looking at this compliance calendar, the standard salary deadline remains unchanged at July 31st. However, self-employed individuals and professionals receive a new August 31st extension. The standard correction window remains intact. Filers still have a 5-month period ending in December to submit revised returns without incurring additional fees. Beyond that, the Act introduces a newly legislated penalty phase. Practitioners get a distinct 3-month window, allowing revised filings up until March 31st, provided an extra penalty fee is paid. Tax consultants and corporate payroll managers must immediately adapt to these parameters. Internal CRM mapping logic needs updating, and Q3 and Q4 workflow capacities must expand to handle the March 31st revision window. In the capital markets, the Act aggressively adjusts friction costs for derivative traders. This chart tracks the precise tax increases. The securities transaction tax on futures escalates from 0.02% to 0.05%. The STT on options sees a concurrent hike, moving from 0.1% to 0.15%. Despite the increased friction costs, futures and options trading retains its classification as non-speculative business income. Because of this specific classification, the inflated STT payments remain fully deductible as legitimate business expenses. This operational detail softens the net impact on traders. At the institutional level, the Act introduces a structural inversion in how corporate buybacks are assessed. Buybacks are no longer classified as deemed dividends, which were previously subject to aggressive slab rate taxation. They are now cleanly treated as capital gains. The Act rationalizes tax collected at source limits. The legacy dual threshold system is abolished in favor of a standardized, flat 2% rate for overseas packages and medical or educational remittances. By reclassifying buybacks as capital gains and standardizing the TCS, the legislation streamlines the tax structure, creating highly optimized yield scenarios for high net worth investors. The final major revision addresses corporate payroll exemptions, which are finally receiving long overdue inflation indexing. The Children's Education Allowance corrects a decades-old limit of 100 rupees per month, escalating all the way up to 3,000 rupees per month. Similar compounding upgrades exist across the board. Hostel allowances rise from 300 rupees to 9,000 rupees. Tax-free meal caps jump from 50 rupees to 200 rupees, and the annual gift exemption triples to 15,000 rupees. The house rent allowance framework also receives a geographic modernization. This map highlights the legacy framework, where the premium 50% HRA exemption bracket was restricted to 4 metro zones: Delhi, Mumbai, Chennai, and Kolkata. The 2025 Act adapts, granting 50% HRA eligibility to Bangalore, Hyderabad, Ahmedabad, and Pune. Corporate payroll software across the country must be reprogrammed at the baseline level. Failing to update these geographic parameters will result in massive tax deduction failures for employees newly elevated into the 50% bracket. This infographic outlines the complete structural reset. The 2025 Act rests on 3 pillars: unified chronological taxonomy, reorganized compliance architecture, and an inflation-indexed fiscal baseline. Practitioners face a tight temporal hazard. The hard implementation date is April 1st, 2026. Institutions must execute a parallel run. They have to process current assessments under the legacy 1961 rules while simultaneously architecting forward-looking compliance measures for the 2025 framework. The central challenge of the 2025 Act is the wholesale migration of an institution's operational memory before the legacy system is turned off forever.